In this episode of Smart Humans, we talk with Derrick Barker, who's the founder and CEO of Nectar, the real estate platform that focuses on multifamily homes and offering debt instead of equity. He gives us his perspective on the market and why he thinks multifamily real estate is going to be very green for the years to come. He talks to us about the cities that he likes, like Dallas or Atlanta, and others that he's less bullish on. And of course, he gives us his picks for 3 years out.
Welcome to Smart Humans with Slava Rubin, presented by Vincent. In this alt investing podcast, Slava talks to amazing minds about their investment journey and finds out what it takes to make it in the markets. And now, here's your host and smart human, Slava Rubin.
Hello, and welcome to the latest episode of Smart Humans. I'm very excited for today's guest. We have founder and CEO of the real estate platform Nectar, Derrick Barker. Welcome to the show.
Thanks for having me.
Absolutely. So we always like to get started with the basic question. How did you even get into this? How did you get into alternatives? How did you get into real estate? Where did it start? Get me from the beginning.
So it started really back when I was a freshman in college. I started a business with a couple of my roommates. It went really, really well. It was not an alts business. It was like a finance type business. But I ended up in the '08 financial crisis. We kind of let it go, like exited or just, didn't make any money, but left it, let it go and started buying real estate. So I've been in the real estate business since my senior year in college. And I worked at Goldman Sachs after trading bonds and, structured bonds usually, and then left there, had about 500 units when I left in 2013 and just spent the next 8 or 9 years buying and gut renovating, rundown apartments, built about a 4,700 unit portfolio.
Wait, time out. Did you say you had 500 units as a senior in college?
No.
Okay, I didn't catch that.
I had maybe 5 as a senior in college. I had 500 by the time I left Goldman Sachs, which is 2015.
So how many years later after college was that 500 units?
About 3.5 years.
Wow. So you went from 5 units as a senior in college to like 4 years later, you had 500?
Yes.
Wow,
Yeah.
That's incredible. So what was that first business? What college did you go to?
I went to Harvard University.
Oh, of course you did. Okay, great. And when you were a freshman, what was that first business? It was like a fintech business, or what kind of business?
It was called the Veritas Financial Group. And it was really a way to get business school students who used to work on Wall Street to teach undergraduates about finance, because Harvard didn't have any finance classes. And then we charged investment banks and private equity firms to do case competitions, to judge case competitions, which really, like, it was a recruiting budget out of their recruiting budget. But for us, we were charging, $5,000 or $10,000 per event per bank. We have 5 or 6 banks. It was a really good business. But it didn't, in '05, '06, '07, it was a really good business. In '08, they were like, we'll come and we'll give you like pamphlets. We're not going to give you any money.
Fair enough. '08 we had some dark days. How do you go from the, let's call it the consulting business, to all of a sudden buying that first unit? What happens? How do you make that decision?
I mean, '08 happened and I'm in college and we were looking around like, hey, finance in Wall Street might not exist. Like me and my 2 roommates, we wanted to go into, Wall Street or consulting. And you're like, well, it might not exist by the time we graduate. So what are we going to do? And we're like, well, it would be great to like buy some derivatives and just ride it out. But we didn't have any money and couldn't get an ISDA. So the easiest thing to do is real estate. We're like, the real estate market can't go down any lower. We were wrong. It did keep going down lower.
Famous last words.
Right. But that's how we got in. We put together a pitch deck. We went and, went out to raise money from, some alums and some donors. And, we started buying.
Where was that first unit?
Atlanta, Georgia. So I'm from Atlanta, Georgia. My family lives here, so we didn't have to pay for a rental car in a hotel. And the economy was pretty good. And prices were low enough where you can buy properties and get really good cash and cash, like 10% cash and cash returns. And we were flipping. So it made sense to be in Atlanta, and that's where we started.
Nice. So you're at Goldman Sachs, you go from 5 units to 500 units, and then what happens?
Then I leave. I left Goldman Sachs.
Actually, how do you parallel being at Goldman and getting to 500 units? I can't even grok that. How does that happen? Are you doing this by yourself? Are you doing this with partners? Are people full time? If you're working at Goldman, tell us about that.
Still the same two partners that I started the business with in college, who were my roommates. And my dad actually, so we were going to drop out of Harvard to do this. And my dad was like, no, I'll retire and I'll like help you run your business. You need to graduate. So my dad was also like helping and, on the ground. But yeah, a lot of flights, a lot of long nights, a lot of working, a lot. It was just a lot.
Fair enough. So you're at 500 units. You leave Goldman. What happens next?
Then I start buying, back then, this is 2013. So you could buy some really, they weren't great assets, 50s, 60s, 70s, 80s vintage. They were built in the 70s and 80s, but you can buy them for so cheap, 13,000, 15,000, or $20,000 per unit. And we would go and gut them. And so eventually we got a team together. We got a management team together. We learned the business from the studs out, every little part of it. And then we got a machine and we were just doing it. We were just doing a lot of it. And then eventually the market just kept going up and we got priced out of the market. By 2020, by that time, my partners and I had gone different ways. We had all gone different places and gotten married. And so, kind of left the business naturally. My wife joined the business. She had her own career and her own portfolio, and we partnered, but we couldn't buy any properties anymore. And so we were like, well, what's a better way to make money in real estate? And one thing that we always had an issue with was, liquidity, just getting liquidity or having a portfolio and needing liquidity. And so we felt like, hey, there's a better opportunity doing something else. And so, so we sold our properties. We took the run up and then sold in 2020. Unfortunately, that was before the big run up in 2021. But I mean, we did okay, and that's kind of how that story went. We still own maybe 350 units, but nothing anywhere like what we used to own.
And then from there, you started Nectar?
Then we started Nectar, yes.
Amazing. So we'll get to Nectar in just a second. But when you said that we couldn't be buying any more properties in 2020, what does that mean exactly for the audience, just so they understand?
So we were always buying properties at a discount and then doing heavy construction. By 2020, when we were going to buy properties, we'd be when we started, we'd be the only bid. Maybe there'd be one other bid. By 2020, there'd be 20 other bids. And there would be people paying way above market. And we just couldn't make the math work. So we knew how much it cost to construct. And we knew that people weren't getting lower prices than us because we had built this machine that was just going. And we didn't know how they were going to make the numbers work because people were paying 20% more than we were paying. And we were paying we were saying, hey, we're going to push. And so we couldn't make the deals pencil out off really aggressive assumptions.
Got it. So, and the math that you're talking about is you would try to find a unit that was pretty challenged and get it at a pretty decent price, got renovated, and then flip it in what amount of time typically?
Starting out, maybe 2 or 3 years. Eventually, we got longer hold periods. So once we did some deals and had a little bit more money, frankly, to be able to survive longer, we hold them longer. We didn't want to sell. We just had to sell to keep growing the business to get the liquidity. So I'd say 4 years on average.
And what was the average price that you typically were entering at into the homes?
I mean, we're talking
to purchase them.
To purchase them, probably $5 to $10 million. We were doing apartment complexes mostly.
Got it. And that was how much money per unit? Like how many units would be in a complex for 5 to 10 million?
I mean, we were, again, we did deals from a 490 unit project to a 17 unit project. So we had a wide range over that 8 or 9 year period. And they got bigger and, then we started just doing things on our own without investors. So then it got smaller again. But I'd say we started out buying properties for maybe 20,000 a unit on average, and then putting in another 20. And then by the end, maybe we were buying properties at 60,000 a unit and putting in 20,000.
Got it.
We weren't always gut renovating. There were some deals that we just bought and we just freshened up. Every deal we did a lot of deals. So, everything wasn't the same. But we made the most money and we were really, really good at buying in new electrical, new plumbing, new systems, new everything.
And is that what's called multifamily, where it's a complex? So that's
Exactly.
different than like a single family home, where it's,
Exactly.
and
Exactly.
and why weren't you going after single family homes? Why was the multifamily the play?
We started with single family homes back when I was in college, but then, being in New York and having a portfolio in Atlanta, we quickly said, hey, we need to do, like, if we bought, a portfolio of quadruplexes, then we can have, 12 units in one place as opposed to all over the city in one transaction. It was just way easier and more efficient. That's what we started. And then, when you do something, you start getting good at it. And then, so we got better at just doing multifamily because it was just easier to manage. And then over time, it turns out it's easier to do bigger deals. Smaller deals is hard to get very high quality contractors and very high quality managers on smaller deals because they're not getting paid enough.
Hmm.
Well, they only have so much time. They want to spend their time doing bigger things. So, we eventually said, hey, we want to hire the best people, or keep the best people who we started with, and then they start getting really good. So we had to just get bigger, and and we wanted to always be focused on really low, moderate income, like working class people, providing housing for working class people because there's just an unlimited number of them. Like that's what most of America is. There wasn't as much competition to provide very high quality housing to them. Most people, they get in and they say, hey, well, we just won't renovate it that much, and so the rent will be cheap. But we said, hey, no, we're going to gut it, and we will also make the rent just a little bit higher than all these other people. Turns out the best renters, even if they're only making $40,000 or $50,000 a year or less, still, if they have good credit and have a good job and they want a stable life, they will pay more. And those are the type of people you want as renters. And so it kind of led us to doing bigger projects and doing multifamily.
Smart, smart. And was this all in Atlanta and the Atlanta area?
We started out in Atlanta, but we eventually got in multiple cities in the Southeast and even Southern California. I had a partner who's based out of LA, so we did some deals in Southern California as well. But say around Georgia, Alabama, South Carolina, in Florida. Sorry, in California.
Nice. So you said you started out with about $20,000 per unit, and then it went up to $60,000 per unit. Obviously, you started in Atlanta. Was that lucky because that's where your dad was and your family was, or would you say that was some really great diligence and analysis as to an underpriced market? And the second part of that question is, would you advise others who are trying to find that similar analysis of the next, let's call it Atlanta? How do you think about that?
So I would say it was both. So I had, as I said, I had two partners, and we were both looking at, and I was in Boston at the time because I went to Harvard, it was in Cambridge. And we looked at Cambridge, and then we looked at the different cities. And Atlanta had the third most Fortune 500 companies at the time, but the prices for a unit of housing were just way lower than comparable cities with the comparable amount of just like um, you know big companies. And so that is kind of where we honed into. But also, we knew the market. Like, there were other markets that were similar, but we knew Atlanta better, and we could just afford to go there because, again, we're college students, and we're, coming back to Atlanta, we had a place to stay. But I'd say the advice I give to people is, in real estate, sometimes execution is more important than market.
Mm.
And it's not all the time. I mean, the market can just go up. And if the market goes up, then it can bail out a lot of mistakes. Honestly, early in my career, the market bailed us out because we made a lot of mistakes. I mean, 22 years old, you're going to make a lot of mistakes, and the market bailed us out. But if you have something that's in a neighborhood that and you just know which side of the train tracks is the right side, and you can go and see the property and see when the contractor says, oh yeah, it's fine, and takes a picture, you can say, okay, well, like right outside the frame, what about that? Especially if you're doing, rehab, I'd stay in the market that first. If you're going to be a passive investor, then I'd say, then you can be diverse. Diversity matters. But if you're going in, you're trying to actively do something, go someplace you can make money doing what and finding places where there's more demand than there is supply. That's what I focus on doing.
Amazing. So obviously you're into real estate. This is a show about alternative investments. What do you think about the other alts in terms of your, allocation of investment? You probably have a little bit of public exposure. But what about all the other stuff? We don't really believe in the 60-40, equities bonds mix. We believe there's a lot to go into alts. What do you think about private credit? What do you think about crypto? What do you think about pre-IPO venture? What do you think about art or collectibles?
Yeah. So I think that those are all great places to have, money. I would say, and I would say the details matter. So something that I learned, is that sometimes it's better to just have concentrated bets on what you really know. And so you ask where my personal funds are. I do have I have money that I'm investing that it is just in real estate. I know real estate. I know it well. I know where, and I'd rather just bet on me. And if I'm wrong, I'm wrong. And then I have money in the Nasdaq. And it's like if America's good, then I'm good.
Meaning like literally the QQQ, right?
Yeah. So like I'd say with investments, I'm also a very long-term holder. It's you can learn a little bit about a lot of things, but that is where you're probably most likely to get in trouble. Private credit, for instance, I know. So I traded bonds at Goldman Sachs. I know a ton about debt. I guess relative to maybe a typical person, but still to bet on a deal or a sponsor or a fund, you really want to do research and know the space. And so mostly I love private credit because of the risk reward dynamics today, and where rates are. But I'd say, my focus is on real estate because I know it. I like doing something that I can do better than anybody else.
Perfect. Do you have any exposure to crypto or to, for example, pre-IPO venture?
I have some exposure to both crypto and pre-IPO venture. Not enough not enough where I need to check on it. Just because the world is, crypto is a technology that's going to be the future. It's going to be there. So I have some Bitcoin and I have some, Ethereum. If it goes up, cool. And then pre-IPO venture, I know a lot of people with startups, and I just invest. I just invest in some of the betting on people. And if it goes up, it goes up. And if it goes to zero, then it's probably going to. It's probably going to zero. Like most of pre-IPO venture goes to zero.
So it's one of those things where it's like maybe 1 or 2% of your net worth you put into those asset classes, sort of thing.
Yes.
Okay. And if it turns into zero to zero for 100x's, that's awesome.
That's awesome. And as a matter of fact, I think crypto may even be more than 1 or 2%, just based on the fact that I bought a little bit a long time ago.
Right. And it's grown.
Yeah.
Good
So
problems.
yeah, I say in investing generally, my philosophy is that if you buy something that you can hold for a long time and then hold it for a long, and let time do the heavy lifting.
I like that. Time do the heavy lifting. Just taking a note. All right. What do you think of the market? I mean, you got great perspective on real estate. So that was a very open-ended question. We just had an election. We're getting a new president. The stock market is hot. There's a lot of things that are popping. Is 25 going to be rough? Is 25 going to be awesome? Inflation looks like it's, not going as low as we want it to, but it's kind of steady. So is it Goldilocks? So just a completely open-ended question. What do you think of the market?
Yeah, I'll talk broadly a little bit, but then, I know real estate, so I'll talk about that too. Broadly, it doesn't seem like inflation is gone. The job market is still strong. The economy honestly is doing pretty well. And that's good. Stocks are at all-time highs. We have an overall pretty, a decent economy. I believe that interest rates just might be higher for the rest of our working lives. I think that is probably something that we should just expect, because I'm looking at where the economy is. It doesn't look like an economy where it makes sense for rates to go down. It just doesn't, other than just people want it to in the real estate space. But rates don't go down because people want them to. Usually if people want them to, it goes up. So that, I think that means that if you're in if you're in interest rate sensitive sectors, then you should just be cognizant of that. Maybe that has an impact on stocks. I'd say a lot of equities seem just fully priced, I'd say real estate is an interest rate sensitive sector. And we have, and to talk a little bit more, drilling in on that and what I really know, we have just come off of a couple of years of just record high deliveries, completions. With that, so that means, after the pandemic, interest rates went down a lot. That means it was very easy to make to build a project, to get the financing to build a project, and for the pro forma to work in a model, because you can look at the interest rates, say, oh well, the cost of capital is so low, I can build lots of things, and then I'm going to exit it at, and interest rates are going to stay the same or maybe go up a little bit, and I'll be able to exit and make a lot of money. So people did that a lot, and we built, we had record amounts of new supply come to market in, let's say, multifamily, but across a lot of real estate sectors. And it takes 3 years to build an apartment complex. So now at 2024, we're just getting the properties delivered that were built in 2021. Well, turns out rates didn't stay the same. They went up, and not by a little bit, they went up by a lot. So you have a lot of people who have loans that are coming due, who have properties that are just finished getting built that are empty because they just finished building it. They have to fill up at the same time, where interest rates are higher. So it's a lot of competition. There's a lot of supply. There's a lot of competition for the renter. And so rents aren't going up as fast. And you have higher interest rates and higher mortgage rates, which means that cap rates have to be higher, which a cap rate, that's basically the property's interest rate. So the higher the cap rate, the lower the price. And so it's a tough time in the multifamily market, specifically for people who bought or started development right after the pandemic and have a short-term loan that's coming due now, because rents aren't growing. For anyone who bought before that period, so if you, like me, if I bought property in 2017, 18, that are like, rents are way higher than anything I had in the pro forma, because there was a huge, rents went up 20% in some markets after the pandemic, and maybe now they're going down 4 or 5%. Okay, it's not that big a deal. I have a low leverage property, values went up a lot, rents went up a lot, and now there's a little bit of reprieve. Some people are going to get hurt really badly. The majority of the market, the fundamentals are very sound. So I say it's a great time to be in the real estate market, particularly if you can pick up some of the new supply or some of like the high quality properties that are just in trouble because interest rates are not what they expected when they bought the deals.
I know it's not your job to predict interest rates for 2025, but you obviously have to have some thoughts. So what do you think is going to happen between now and the end of 2025?
So I traded bonds at Goldman. And one thing that I said then, and I say now, is like, I'm not an interest rate trader. Like I don't want to build a business model that's reliant on rates, on interest rates going up or down. That being said, I do have a view, but take what I say with a grain of salt, because I'm not an interest rate trader. I can't imagine interest rates going much lower than where they are without the economy getting worse. So if unemployment goes up meaningfully, if we have a slowdown in growth, meaningful slowdown, then I can see interest rates coming down. Otherwise, I see 2025 being around where they are now, interest rates being around where they are now, in plus or minus, up or down 50 basis points or so, based on just how the economy is doing. But for interest rates to go down meaningfully, we will have to have a real meaningful decline in the economy.
I mean, it's pretty contrarian to what the talk was a few months ago, right? When we were saying that it should probably be another 200 basis points by the end of 25, right?
Yeah. I mean, I might be wrong.
No. It just shows that how strong the economy is.
But yeah, the economy is strong. It's like when the Fed says that they're going to be higher for longer, and they say that it's going to be data dependent, I just take them at their word and don't overthink it. Like, interest is probably going to be higher, and it's probably going to be for longer, and they're probably going to look at data, and the data is not bad.
So give me a street light, red, yellow, green. What color is the market for 2025?
For which market?
You can answer how you like.
Yeah, and I will say that I'm a macro, like, you have to have macro context, but like the details matter in terms of what you're buying. But I say in general, if you're looking at real estate and you can buy high quality assets, is a great time to be invested in, especially like I know multifamily very well, and it's a great time to be invested in multifamily. The fundamentals are incredibly strong. We have a huge housing shortage. And we have structural issues that are going to make it so that we're not going to be able to create a lot of supply, enough supply to meet the demand.
So does that make you green in 2025 for multifamily?
That makes very green, especially at a time where there are people that are going to be distressed. So green for, I say green for multifamily real estate. Um,
Awesome.
yeah. I might be yellow for some of the other risk assets just because there's been a run up, and things feel fine. But like
What
I
what
like,
what are you considering those risk assets, just so the audience knows?
equities or even private equity, things like that. Just because if interest rates are higher, a lot of people are pricing into their brain, into their business model, and into their projections that interest rates would be lower. And I think we have just the same probability that interest rates are higher by 1 or 2 points
Nice.
in a year or two.
So tell us about Nectar. Not everybody knows what it is. Obviously, you're doing a very successful real estate business. What is Nectar?
So Nectar is a real estate company that provides liquidity to owners of commercial real estate who have low leverage cash flowing assets. So how do we do that? We provide, we work with people who typically have portfolios of, say, 50 to $500 million worth of stabilized properties with permanent debt. So these are not like newcomers; these are people who have portfolios, and they may have if you have a portfolio of these assets, a lot of times you need $1 million, $500,000, a couple $1 million to finish a renovation, to buy another property, or take advantage of an opportunity. But we provide liquidity to those people so that they can take advantage of opportunities by providing mezzanine financing to their low leverage and cash flowing properties.
Nice. So, and your customer is who? The accredited investor or retail investor?
Accredited investor. So we have a fund that takes capital from accredited investors.
Great. So if I wanted to invest with you, what are my options as to how I would invest? Do I pick the actual managers and the buildings, or do I invest into a fund, or how does it work?
Say the best way to invest with us is investing into our fund. Our fund pays quarterly distributions backed by dozens of properties across 29 states. We're it's diversified. The underlying investments that we make are amortizing, so we get principal and interest back, paid currently monthly. So it's getting de-risked every month. We're reinvesting that principal, so your investment gets de-risked and delevered every month. I'd say for existing investors, we have other options and we have co-investment opportunities. But I'd say for the typical investor, you're best served by investing in our fund.
And is there a minimum that I would need to invest?
Uh, for for listeners of this podcast and for people coming into Vincent, the minimum is $10,000.
Got it. So I would invest $10,000. I do that. I have to be accredited, not just a retail investor. So do I give you all $10,000 tomorrow, assuming I sign up tomorrow?
Yes, you give us all $10,000 tomorrow, so you sign up tomorrow.
Great. So I give you $10,000, and then I'm not actually getting exposure to the real estate equity, right? So if the building goes up from worth 5 million to 8 million, I don't get any of that. Is that correct?
That's correct. That's
Right.
correct.
But I do
When
get
you go from 5 million to 4 million, you're also probably not going to be hurt. Also,
perfect. So I don't see the downside either. But I'm going to be getting yield out of their rents, right? So they're going to be getting money, and I'm going to get a piece of that. So what's my annualized return on that $10,000?
yeah. So at the $10,000 threshold, you get paid quarterly dividends of 12%, or 12% annualized, and for we have for anyone who invests 250,000 or more, then that's 14%. So we have two levels of investment, and yes, this we get money come in from our investments, which again are mezzanine, so we're senior to equity. Across the fund, we're at about 65% leverage, so it's a very secure investment. I think of this as a way to get extra yield on a very low risk type investment.
Got it. And so let's say I did do the 250,000 just so we could keep it mixed for different audience members, and I get 14%. So that's 3.5% that I'm going to get every quarter, basically, right?
Exactly. Exactly.
And so
Key point, not 14% every quarter.
yeah, 14% annualized. So is that pre fees or post fees? And what are your fees?
That is post fees. So we are invested also, and we get the net interest above that 14%.
Got it. So maybe you're, I don't know the numbers. I don't know if you can share them. Are you making like 20% or 16% or 30%? What does that look like?
I say typically we're going to be in the high teens to 20.
Got it. So you're making like 20% as Nectar, and then there's some fees there, or maybe that was post the fees. So then you keep the 6% and then you pay out the 14%. Is that right?
That's right. That's right. So
Okay.
we earn the fee as we're getting paid back and paying investors, we're earning alongside,
So,
as opposed to just a management fee on capital that's invested.
I mean, 14% for 250K sounds like a pretty good number in terms of a rate. How does that compare versus competition or other type of yield oriented assets like that?
I'd say the best thing to compare us to is probably like bridge debt. Like, there are a lot of funds that do construction mortgages. We don't take any construction risk. We don't take lease up risk. We don't take interest rate risk because our investment is, it matures before the underlying mortgage, and we're only behind fixed rate mortgages. We're lower leverage, so the 65%, up to 70% range for the underlying assets. So I'd say we take much less real estate risk and much less business plan risk than like a mortgage fund or a mortgage REIT. But we have structural risk because instead of having the first mortgage, we're in the second position. And so I think of it, so we're in the second position, but we're at a lower leverage on a stabilized property. So I'd say we're similar to that risk profile, except for more yield. So those, first mortgage REITs are going to probably be in the 10, say 8 to 11-ish range. And we're a little higher than that.
So talk me through that. So you're in the second position to the mortgage, and the mortgage will probably get 10 to 11%. But because you're in the second position is why you get the higher return. Talk to me, what is that risk exactly? So let's say I'm not a real estate investor. What does that mean? I'm in the second position to the mortgage. And how does that actually manifest when it becomes a problem? What would that look like?
Yeah. So that means that the first mortgage, if the property owner is unable to pay the mortgage and unable to make payments, the first mortgage can foreclose. So that means they can they go through a legal process. It takes some amount of time, but they can take the asset and sell it and wipe out all the equity. So like so you're really secure because the value of real estate doesn't fluctuate all that much, relative to say equities or stocks. It's rare that the value of a property will go down 20%. So, the first mortgage is pretty secure in that sense. But because of that, first mortgages often go up to 75 or 80% leverage. And and often first mortgage lenders are willing to take construction risk or lease up risk. So you have to actually fill up the building because they know if you can't fill it up, then they could just sell it to someone else at a discount, but then someone else is taking to fill it up. For us, we're not looking at properties that need to be fixed or renovated or built or leased up. We're not taking that risk at all. We're only, we're working with that, or we're investing in properties that are already stabilized, that are already cash flowing. They don't need to do anything except for continue to operate. If operations, and that's where most of the risk is. The most of the risk is construction and lease up. The way that you get in trouble, that we get in trouble, is if a sponsor has a property that was doing well, but for some reason, a big factory shuts down and it had a lot of the residents, I don't know, or like a hurricane hits and people don't come back to the city, like in New Orleans, maybe things like that. That would have an impact because then operations for even stabilized properties would decline. All of our properties can withstand a 10% revenue decline. So we underwrite so that even if there's a 10% revenue decline, then we're still covered. But if they don't pay us, we have the right to sell the asset. So whereas the first mortgage, they have the right to foreclose, a legal process that takes a long time. We just have the right to say, hey, things are not working out. We're going to sell before the first mortgage can foreclose. We can sell it at a discount if we have to, but we will be protected because we're at a lower loan to value.
Got it.
Does that make
And
sense?
yeah, no, it makes sense. Obviously, it's a little bit complicated, which is also why there's a little bit more return, which is all great. And I mean, if everybody knew how to do this, then everybody would be doing it. But that's why you have Nectar.
Right.
Um, so do you diligence the operator or do you diligence the building or both? Meaning, how do you do your underwriting?
Yeah, both. We do a pretty extensive underwriting, but there are 5 pillars. One, quality of operator. Does this guy have a track record of paying their bills? Have they completed this business model? Do they have properties that are stabilized and cash flowing for a long time? We check bank statements. We check legal records and do state searches. Then the asset, is it actually cash flowing? Have they been cash flowing? Are they stabilized? Do we believe they're going to continue to be stabilized? Then leverage, is how leveraged is this property? If there's a 20% correction in the market, in '08, the market probably corrected about 20%. So if you have an '08 level correction, can we still get paid back? So those are the 3 first primary things. Then after that, we need to make sure that we KYC check, make sure the person that we're talking to has the right to enter into the agreement. So they have to, a lot of times these properties are owned in LLCs where there are a lot of people at the table and maybe there's a partner that has to get permission from another partner. We make sure that everyone who has permission, they can do it, and then does the sponsor have actual, and is the asset, high quality? Is it a quality asset? If is the roof falling in and is it falling apart? If not, then it's not going to last for the term of our loan. But if it's high quality, has low leverage, quality cash flow with high quality sponsor, then those are the deals that we do.
Awesome. So just to be clear, you're not the ones running the building. You're the ones choosing the operator in the building to potentially give them a loan, which then your investors get paid back.
Exactly.
Great. And are there specific parts of the country, and this is U.S. based, right? Are there specific parts? Are there specific parts of the country that you like or you look for in terms of cities or markets?
We do like some markets more than others. So places where there's just underlying growth, employment growth, population growth. However, I would say because of the nature of what we do, we're only investing in properties that are already cash flowing,
Right.
that have low leverage, and they've been cash flowing for a long time. And even in weaker markets, existing cash flowing properties typically stay cash flowing. So we're open to go into smaller markets or markets that are not necessarily growing because we're not betting on growth. We're betting that a property that is currently performing, that has low leverage, will be able to continue to perform at least 90% as well as it's currently performing. Like that's what we're doing.
How do you identify these buildings and operators and this opportunity?
So we work with, in every market, there are service providers that work with the top owners and operators. And typically we are, working, we have great relationships in the space because, me and other people on the team have been in the multifamily and in the commercial real estate space for 30 years. I haven't been doing it for 30 years because I'm 37, but, other people on the team. And so we leverage those relationships to get in front of very high quality sponsors with very high quality properties that need liquidity for typically to renovate their existing portfolio or to grow their existing portfolio by buying new deals.
Amazing. And I know this isn't your focus, but while we have a real estate expert like you on, what are 3 markets you like for the next 3 years and 3 markets you don't? When I say market, I mean like a city. Give me 3 cities you like. Let's call them green, and 3 cities you don't like. Let's call them red.
3 cities I like. I would say, Dallas, Atlanta, and Tampa. I say those 3 markets are just in the Southeast. There's just a lot of growth. There's probably Phoenix, another market that
Sorry, what was your third one? I didn't hear it. Dallas, Atlanta, and which one?
Tampa.
Got it. And then you said Phoenix. And then what are three cities you don't like? Three cities that are red?
Three cities that are red. Uh, I mean, we don't focus that much on markets that we don't like. um, I'd
Well, to
say,
like something, you have to compare it against something you don't like. So,
yeah. I mean, I'd say some of the like Buffalo, no, we like Buffalo, New York too. Sorry, I'm botching this question.
it's my first gotcha.
I know. And you said you don't have any gotcha questions, and you don't. I don't know why. We don't have a lot of cities that, because we're focused on properties that are low leverage and cash flowing. I mean, we don't. There
Right.
are markets that we win, like rural Michigan. I say something like rural Michigan, rural Wisconsin, like very very exurban markets. We don't like necessarily. They don't have a lot of that don't have a lot of drivers that have like single factory risks, things like
Mm,
that. Those are things that we don't like.
super
Uh,
helpful.
yeah.
Awesome. So that was great context on Nectar. Is there anything I didn't ask that you would have wanted to tell me?
Now I say like maybe the thing that I say is just like the security of Nectar. We have rights like owners because we have the right to sell these assets, but we have risk like lenders because we're senior to the equity and only low leverage cash flowing properties, and we're diversified. So you mentioned the top three markets that we like, but the reality is we are in dozens and dozens and dozens of markets, and that's kind of the point. The point, and that's why I said it's better to invest in the fund than an individual deal,
Sure.
because some of this is just there's diversification, and we sleep very well at night because even though there might be a hurricane that hits Tampa and it just might hurt cash flow for some amount of time, we don't have any single deal that's a big part of the portfolio. We have lots of property spread out across lots of parts of the United States. In diversification, low leverage, and cash flow are something that can bring the risk in a real estate transaction down pretty low, and that's what we like.
What year did you start Nectar?
2021.
And what's like your AUM or number of investors or any metrics you could brag about?
I'd say our AUM is probably is around 50 million. Our uh-oh, are you still there?
Yeah, I'm here. You're good.
Sorry, I got to pop up to reload the site.
You're good.
Okay. Sorry, can you restate the question just one more time? I'm sorry about that.
Yeah, I asked what year you started, and then you said that was 2011. I asked for any, interesting metrics like AUM. You mentioned it was 50 million of AUM, and then maybe how many investors you had, or how many transactions you've done, how many buildings, etc.
Yeah. So I probably don't want the AUM is a complicated one because we have a credit facility and we've done most of our deals in the credit facility, which doesn't count towards our AUM. But so why don't we say, and I started in 2021. Um, Now we have over 100 investors. We've done 120 deals in 29 states. Our fund has made 11 consecutive quarterly distributions where we've paid on average 14%. And you know, yeah, I think those are some pretty. We're 65% leveraged across our portfolio,
Yeah, this is
and for
great.
every no, sorry.
All great. All great. So now that we're getting to the closing stretch here, we all want to be as smart as you. What is it that you like to read, watch, or listen to?
So I really like reading and listening to biographies and lessons from older entrepreneurs and investors. So Ray Dalio Principles, for instance. There's a podcast called the Founders Podcast, which is just biographies of great entrepreneurs. So these are things that I really like stuff like that, and then just not business things. Like there's a book called Zealot by I'm gonna botch the name of the author, so I'm not gonna say it, but Zealot, which is a not a religious story by a non-religious biography of Jesus Christ,
Nice.
which is like super interesting. So I say those things. Because history repeats itself, and the market goes in cycles, and you can learn a lot by just listening to what people who already built businesses and built investment companies did.
Amazing. And then any one piece of content that you like to read, a newsletter or podcast related to real estate or any type of news source that keeps you smart?
That's specifically real estate focus. Um,
Anything that's business focused that keeps you smart, on a daily, weekly basis?
yeah, I read, I look at like Biz Now or a lot of different, like CRE type, journals and publications. But I don't have anything off the top of my mind that keeps you smart. I don't like looking at commentary. I like just seeing like what happened and then looking at history,
I
like what
love it.
happened. The interest rate is here. Like there's no commentary needed. This is where the interest rates are. And then in the history, this is what happens when interest rates have changed. So I'm more of like a history guy because I think most commentary is wrong.
Perfect.
Clouds your
And
judgment.
give me the facts. I'll figure it out. So last question. We like to hear 3 years out. What are your picks? One public markets pick and one private markets pick. So for public, give us any stock that we could go trade if we wanted to. For 3 years out, it would be a winner. And for private, it's any asset, any fund, anything that's in the private markets.
Yeah. So for the private markets, I'd say it might be cheating, but Nectar Fund, I'm literally betting on that because ultimately I think that there's just a lot in real estate, especially for right now, properties that are cash flowing, they're gonna have a run. There's gonna like once all the supply that's currently in the market gets filled up, interest rates are higher, it's harder to build. Like real estate is, I believe, gonna have a big run, and we have structurally, um, you just have like a structural supply demand mismatch for the ability to supply the amount of real estate that our country demands. Um, and then to balance that, I would say honestly, this is not a stock, but I think Bitcoin. People call it digital gold. It is a fixed supply, and we're going into a world like the next 30 years are going to be different from the last 30 years. We're going into a world where um, centrally controlled currencies, I believe, are gonna we are gonna want alternatives, and Bitcoin is an alternative where a sovereign is not controlling the currency. And I think that that's something that's going to be important.
I love it. So both of those are private markets. So you still owe me a public market one. So
Uh,
so Nectar Fund is cool. Looking to try to get 12 to 14% Bitcoin today, hovering at recording at around mid 90s. Very interesting pick for the future. What's your public market pick that somebody can use Robinhood and go buy?
I'd say, you know,
We're making Derek think.
I just feel like if I give an answer, it's gonna be bad. I wrote down something, but the reality is I know so much more. Like I said earlier, I'm a guy who like I do the things that I know, and I don't really take flyers. And if I did, it would be a diversified basket of stocks like the Nasdaq. The Nasdaq is
All
like
right. So your play is QQQ.
my play is QQ. Just bet that the future of is more leaning towards tech, and I feel like it's a basket that is that's diversified enough, and that has forward facing companies that are going to be able to whatever happens from the inflation perspective. Uh, you know, I believe that the American economy is strong and will continue to be. And the details is just more uncertain and more unclear now than ever before. So I'll just do the Nasdaq.
Perfect. Well, thank you so much. We've had an incredible conversation here, starting out as a freshman in college at Harvard, thinking about how he could help to make entrepreneurs, but then turning that into his first 5 buildings as a senior. Then going from there to 500 units just a few years later, which is absolutely amazing. Got the real estate bug, going from 5 units to 500, starting buying units that were 17 unit buildings to multi 100 unit buildings. From $20,000 a unit to $60,000 a unit, you saw the ride go up, but you were ahead of the game starting in Atlanta. I like this one. Execution is more important than the market. It's the first time I heard that, which is awesome. You like to concentrate your investment on things that you know, and you like to bet on yourself, like a lot of our guests, which is amazing. You think it's going to be a decent economy. You think the interest rates are going to stay high probably for a while. You're not sure if the interest rates might even go up a little bit or go down a little bit, but there's not going to be a huge drop like a lot of people are predicting because employment is too strong. You do think it's pretty green, especially for multifamily, maybe a little bit more yellow for the risk assets like equities or PE. And you have the amazing company Nectar that you started in 2021, already have a ton of transactions, 10,000 minimum to enter. You have to be accredited. You could do a $250,000 minimum for a higher return, 12 or 14%, which seems pretty awesome. The major risk is that you're in second position to the mortgage, but you're already post-construction, people filling up the apartments, low leverage. You have your 5 principles as to how you diligence, which is awesome, which people should listen to. You gave us our cities that are green for you: Dallas, Atlanta, Tampa, Phoenix, also some red cities. You couldn't really name too many, but you love the idea of rural Michigan, rural Wisconsin, where you have single factory risk, not a lot of drivers. Those are the factors that can become a problem. You like biographies. You like to figure out the facts yourself. Look at history, Ray Dalio, Founders Podcast, Zealot, BizNow, CRE, and you gave us some picks, which was, of course, the Nectar Fund, BTC. And then you weren't willing to take a single asset pick in the public markets, but you gave us QQQ. Thank you, Derrick. It was a great conversation.
Smart Humans with Slava Rubin is a podcast brought to you by the team at Vincent. Any data, text, or other content in this podcast is provided as general market information and not as investment advice. Past performance is not necessarily an indicator of future results. For more information on alternative investing, check out Vincent at www.withvincent.com.